Well, friends, good morning. Jayadna Rana here. So, I'll discuss today the changed role of insurance regulator in India. The changed role of insurance regulator in India. So, the Insurance Regulatory and Development Authority of India is a statutory body to regulate, promote, and ensure orderly growth of the insurance business and reinsurance business in India. Based on the IRDAI's initiatives to promulgate consolidated and principle-based regulations to govern the insurance industry, the Life Insurance Council and General Insurance Council, these are the representative bodies of the life and general insurance, respectively. So they constituted the regulations review committee to review the entire insurance regulatory framework and recommended principle-based regulations. So the regulation review committee worked with several stakeholders and submitted its report to the IRDA in 2023, recommending a principle-based framework for registration and regulation of Indian insurance companies. So the objective included developing simplified, principle-based, rationalized regulatory regime to enable ease of doing business and removing redundancies and duplications in the existing regulations. So the RRC recommended consolidating the erstwhile 72 regulations into 9. So basis the RRC report, the IRDA notified the IRDA registration, capital structure, transfer of shares and amalgamation of insurers, Regulation 2024. So the IRDA notification or notified the master circular on registration, capital structure, transfer of shares and amalgamation of insurers 2024 on May 15, 2024. So except for the aspects relating to the listing of Indian insurers on stock exchange, all key changes from the erstwhile regime relating to registration, capital and transfer of shares of an Indian insurance company are there. So let us see what these key changes are. The 2022 regulation itself, to begin with, were principle-based and consolidated various IRDAI regulations, circulars, guidelines and directives. So with this, the introduction of de-minimized exemption on applicability of lock-in was there. The 2022 regulations specified a lock-in on every share issued by an insurer, which resulted in a change and shareholding pattern of the insurer. So the regulatory intent behind such a move may be to ensure that the fit and proper IRDAI approved promoters remains responsible for capital requirements of the insurers, especially in its infancy. However, a blanket lock-in condition applicable to every shareholder of the insurer was cumbersome and excessive, especially for employees who exercise their stock options and had minimal shareholding in the insurer. So under the 2022 regulations, there was no de-minimize exemption provided from the lock-in related conditions for minor shareholders or employee shareholders. Further, it is pertinent to note that in accordance with the Rule 12.6 of the Company's Share Capital and Debentures Rule 2040, the employee shareholders are subjected to a minimum vesting period of 1 year between the grant of options and vesting of options. So, Regulation 8 of the Registration and Capital Regulations provides that employees, shareholders, and shareholders holdings less than 1% of equity shares of the insurer shall not be subject to regulatory lock-in. And exempting the employee shareholders from lock-in, the regulatory intent may have been to avoid subjecting employees to two vetting period, one under Rule 12.6a of the Company's Share Capital and Debentures, Rule 2014, and the other under the Registration and Capital Regulations. So IRDAI's power to relax lock-in expanded under the 2022 regulations in terms of the provision and regulation 6.1. The IRDAI had limited powers to relax lock-in, only to enable an insurer to list its shares on a stock exchange in India under the Registration and Capital Regulations. So the IRDAI's power to relax lock-in has now been expanded to two new areas, one in case of distressed financial position and two in case of amalgamation or reorganization, pursuant to change in applicable law of an insurer or its shareholders. So given that promoters have not been explicitly carved out, so the lock-in relaxation owing to distressed financial position includes such situations for both insurers and promoters of insurers. Non-lock-in investors in mature interest elect. So apart from the rationalized lock-in prescription under the 2022 regulations, the IRDA has further relaxed lock-in on investment after 15 years from the date of certificate of registration of the insurers. So investments by promoters of such insurers are subject to a lock-in of 1 year. All investments by investors in such insurers are not subject to a lock-in. As per data available in the public domain, 38 out of 60 IRDI registered insurers are aged 15 years or more. So the investors existing and potential will stand to benefit from the removal of stock-in. Such a relaxation will also benefit investors who may have otherwise been averse to the sector owing to the regulatory lock-in requirements. The enhancement of governance requirement by avoiding potential conflict of interest is there. Although the IRDI Corporate Governance for Insurer Regulations 2024 is the primary source of regulation governing the corporate governance requirement of an insurer, there are a few additional requirements under the Registration and Capital Regulations as well. So in addition to the requirements under the 2022 regulations, the Registration and Capital Regulations now bar any shareholder from having nominee directors on the board of more than one insurers engaged in the same class of business. In terms of paragraph 1 of chapter 2nd of the 2024 Master Circular, insurers are required to comply with such requirement before March 31st, 2025. So accordingly, nominees, directors already appointed on the board of multiple insurers in the same line of business will have to step down from the board of such insurers, all but one, in a time-bound manner. So this will go a long way in avoiding potential conflicts of interest. So under the 2022 regulations, there was a requirement to disclose common holdings to all investee insurers in case an investor had shares in multiple insurers. Such a compliance requirement was impractical for listed insurers whose shares are traded on the bourse by the retail investors. So by applying a de-minimized exemption to shareholders holding less than 1% shares in the insurers, the Registration and Capital Regulations have resolved this anomaly. Now empowering competent authority for various approvals for the registration and capital regulations at various places. Introduce the concept of a competent authority to mean either the chairperson or a whole-time member committee or whole-time member or an officer of the IRDAI as may be determined by the chairperson. For the registration and capital regulations, empower the competent authority for the purpose of various approvals and decisions. For example, an application to relax the lock-in shares of an insurer can be processed by the competent authority. So upon assignment of competent authority for various matters and listed in the registration and capital regulations, processing of applications may become more efficient and streamlined. Earlier, the IRDAI had to utilize its powers of delegation under the IRDA Act 1999 to delegate various matters for operational expediency. Now, share issuance at face value during registration processes is also necessary because the registration and capital regulations provide that all equity shares issued by an applicant till the grant of certificate of commencement of business must be at face value with no securities premium. However, upon hitting the milestone of the commencing business, any further funding rounds may involve a securities premium. So under the erstwhile regime, though it was not specifically codified, it was developed as a practice. Such a practice helps achieve price neutrality till commencement of business and avoid differential pricing for different shareholders. For example, a co-promoter who is not a distribution partner being charged a premium. Then codification of withdrawal of registration application. So due to various reasons, applicants may wish to withdraw their application seeking registration with the IRDAI as an insurer. Under the erstwhile regime, there was no procedure to withdraw such an application. As such, applicants could withdraw their applications if they believe that their application could be rejected by doing so. The applicants would avoid the consequences of an application rejected, including inter alia being ineligible to reapply for registration for a certain time period and triggering disclosures requirement to other regulators that such application has been rejected by the IRDAI. So thus, to plug this gap, the registration and capital regulations codified the withdrawal of applications for registration as an insurer. So under Regulation 6, subsection 7 of the registration and capital regulations, applicants are now required to apply to the IRDAI for withdrawal, citing reasons. If the IRDAI rejects such a withdrawal application, the registration of application may still be decided on merit. If the IRDAI then rejects the registration application, all the consequences of rejection of application shall be applicable. Codification of withdrawal process may have been sending a strong message to stakeholders regarding the seriousness of the application process. We anticipate that it will help filter non-serious application from applying and at the same time allow the IRDAI to accept withdrawal of applications on a case-to-case basis. So 2022 regulations marked an important milestone in IRDAI's regulatory regime. Governing insurers, registration and capital regulations have been developed. Basis industry representation and feedback submitted by the RRC after engaging with various stakeholders and advisors. They factor in certain practical difficulties in enforcing the 2022 regulations and represent a fine-tuned version on it. So with various relaxations to regulated entities while incorporating the regulatory experience of the past 2 years, while accepting industry suggestions, the IRDAI has also introduced aspects coming out of its own experience with the 2022 regulations. So with an amendment bill in the work for the Insurance Act 1938, we may see more sweeping changes. So this is the situation of the IRDAI's regulatory reform series, registration and capital structure of the Indian insurance companies. And here comes the change role of the insurance regulator. Thank you very much.